welcome to our channel. My name is Alice. I'm an artist and a bit of a budding entrepreneur, and I just wanted to make a video breaking down the jargon of stocks and shares and investing your money. It's usually a topic that a lot of us shy away from, maybe because it feels a bit inaccessible. So what I wanted to do was break all that jargon down for you and give you a bit of a better idea of how to invest your money. So if you're ready, let's get started. So what are stocks and shares? Bit of a simple question, but one that I think a lot of us would struggle to summarise on the spot. As we know, in order for a company to grow and develop, it needs to invest in its business. And that's what it does on the stock market. The stock market is giving that company the opportunity to raise a bit of money by selling parts of its business off as shares, or otherwise known as equities. Now, much like a piece of cake, a share represents an equal portion of that company's total capital. So if you own a share, you own a portion of that company. You are a shareholder. And it doesn't take a genius to realise that the more pieces of cake you own, the greater portion of ownership you have of that company. Now, as I said before, shares can also be referred to as equities, as stocks, as securities, but for today, we'll keep it simple and just refer to them as shares. Now, the stock exchange or stock market is where shares are publicly listed and traded. Now, a lot of ideas come to mind when we think of the stock exchange, especially if you've seen films like The Wolf of Wall Street, a lot of people in a room with their hands in the air. It's not quite as dramatic as that. In fact, a lot of trading is done online. For example, in the UK, we have the LSE, the London Stock Exchange, and that's where shares are bought and sold. Now, each share has a buy price, known as a bid, and a sell price, known as an ask. So in order for you to buy or sell shares, you'd need to place an order through a stockbroker. A stockbroker is essentially a company that has the license to give investors access to that stock market. Stockbrokers may want to work with their investors, some like to give advice, some like to offer online trading services. Of course, there are investors that prefer to make their own decisions when it comes to trading. It all depends entirely on the investor and the stockbroker and how they prefer to work together. Share prices are influenced by a number of things, such as the general performance of a company or general economic conditions. It could be what the market, so buyers and sellers, think the shares are worth, or news about a particular company could be evaluated by investors, and how they react could cause share prices to suddenly increase or suddenly decrease. Now, once you own a share, you've become a shareholder. And it used to be the case that this was done in a form of physical proof, like a certificate to show that you had ownership of that share. That isn't necessary anymore. Most shares are held electronically. And you may also receive financial reports or voting rights and shareholder decisions, as well as the potential benefit of dividend payments. And once you own shares, you can generally sell them whenever you like. So why invest in shares? Well, it's all to do with your money, how quickly your money can grow. Now, simply put, your money has a greater potential to grow much faster on the stock market than if it was to sit in a savings account. But of course, there's risk attached to that. Now, there's two main ways that you can make money through investing in shares. The first being capital growth. Now, every share has a bid buying price, and the price you bought it at, you might want to sell it at a higher price. There you've made a profit, you've made capital growth. Similarly, you may have to sell your share at a lower price than when you bought it, and you could make a capital loss. And as we know, the market fluctuates, a share's attractiveness and a share's value fluctuates as well. So it's all about being clever with when you decide to sell your shares, if you do. Now, most people buy shares with the intention of making capital gains. So whatever price you bought the share at, you want to sell at a higher price, and then you've made a profit, you've made a capital gain. Likewise, if you're in a position where you have to sell your share for lower than what you bought it for, you've made a capital loss. And as we know, the market fluctuates depending on a company's performance and its attractiveness to buyers at the time. And secondly, shares can also offer an income in the form of dividends, which is your share of company profits. This is why people invest in companies, for those dividend payments. And a dividend is a payout from the company to its shareholders, to you, which represents a portion of the profit that it's made. Now, not all companies have to pay out dividend payments, although many do, and successful companies may choose to increase their dividend payments as their success continues. However, nothing is guaranteed. So just keep that in mind. Much like share prices can fluctuate, so can dividend payouts. And especially if investing in shares is something that you want to do on a long-term basis, a long-term income, it's certainly something that you want to consider when choosing what companies to invest in. Now, of course, share prices are determined by supply and demand. Supply being the number of people who want to sell the share, and demand being the number of people who want to buy that share. So investors will look at a company and look at its future prospects. How are things set to look out? Are things looking to improve, or are things looking to get a bit worse? Now, if a company is looking to do extremely well in the next few years, people are going to want to buy those shares. Of course, their price is going to increase. Similarly, if the prospect is looking not so rosy for a particular company, you may want to cut your losses and sell your shares, and of course that will cause the value to decrease. So I touched on this slightly before, but factors that can affect the demand for a share include, but are by no means limited to, the national or global economy. So for example, an increase in consumer confidence may lead to more spending, and that of course could lead to future profitability. It could be sector-specific events. So for example, an oil company is open to the movements of the price of oil. It could be to do with competitors. So if we're going to use airlines as an example, if Ryanair was struggling, more travellers were using EasyJet, therefore the shares in EasyJet are much more attractive to invest in. Or there could be company specifics, that includes things to do with management, with strategy changes or speculations. So you've decided you want to invest in shares, but of course there are risks involved. As we know by now, shares have got the ability to suddenly change, for example, due to a company announcement. So it is therefore more suitable to look at investment in shares on a medium to long-term basis, and that's just to give yourself time to recover from any financial dips that will happen along the way. And it's all about balancing the rewards with the risks. So, for example, a small company that's just started up will have a much higher risk in investment than if you were to invest with an already established large company. However, the growth in that small company in those initial stages of investment may be a lot quicker. It's all about balancing that reward with that risk. So you want to set out with some goals and a time scale before you even get started. Now, of course, there are ways that you can manage this risk when you're investing in shares. The first being diversify in your shareholdings. Don't just invest in shares in one company. You could look into other companies, into other sectors, other industries, as a bit of an insurance policy, if you like. If a certain company or sector was to fall, you'd have investments in other shares in other companies to keep you afloat and help even out any financial losses. Secondly, diversify in your investments. You may not want to just invest in shares. You may want to look into investing in bonds or exchange traded funds, something different like that. So look elsewhere on the market as well. You've also got to look at it on a long-term basis. As we know, share prices fluctuate. Look at everything on a long-term basis. I'd say at least a 10-year basis actually, in terms of your income from shares. Make sure you know what you're doing as well. Do your research. Look into what sectors and what companies are set to have good future prospects, and do your homework so you're much more savvy on the stock market. So that's everything that I've got to speak about today on the most basic terms when it comes to your money and stocks and shares. I hope it's given you a bit more of an insight in what to do with your money, and I hope to see you again. Don't forget to subscribe, and see you soon.